Hey everybody, this is Kyle Knott, and I am not your average finance guy. Today we're going to go through a little example here of probably what everyone's doing, and kind of, it wasn't really taught in school. None of that shit was taught in school, but this is probably how most of America goes through their banking system, right? So you got your income, that you got your paycheck that comes in every week, month, every other week, whatever it is. No numbers on here, but the income, we put that into our checking account, right? So the checking account in the bank, it's usually, mine's direct deposited, and it starts real high, and then as the month or the pay period goes on, it goes down, 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 down. We got all our expenses coming out of that. We got our mortgage, our utilities, cars, groceries, credit cards, etc. Everything that we have to pay throughout that pay period, slowly makes its way out of our account. So hopefully there's a little bit left at the end of that pay period that we can go over and we put it into our savings account. Okay. Right now, the average savings account is 0.5% interest. So whatever money you have in here, say you want to save up for a purchase, you're saving up for something. I don't know what it is. Maybe you're trying to get a car, a down payment on a house, get out of credit card debt. All of that stuff doesn't pay you anything, right? But let's just say that's what most of America probably saves up for. So every pay period, they got a little bit coming over here, and slowly, pay period by pay period, it comes up, it comes up, it comes up until we have enough to get that purchase. Once we get that purchase, boom, we take all of our savings or most of it, and we dump it over here, and we buy the thing, whatever that thing is. And as soon as we do that, this goes all the way down to zero, or maybe hopefully you leave a little bit in there for a little bit of a cushion for a rainy day or whatever. So that's probably how most of America does this. Now, if you've got a higher income and you're able to put more or whatever it is, you're able to build that up faster. Hopefully you get to the point where you're buying an asset. Now, an asset is something that makes you money. I've got rental property, so that's a perfect example of I would bring this up as high as whatever I needed for a down payment, and then I would take that whole thing and I would put a down payment on the asset, on the rental property, and then that rental property would cash flow. I'd get a tenant in there, and they would pay all of the bills, and then at the end of the month, hopefully there's a couple $100 left over, and then that couple $100 now goes into here as well. So now I've got my income that still comes in, but now I've got asset that comes in, and it's going to build this up a little bit faster. Once you get to here, buy your second asset, that's 1, 2, 3, but buy your next one. Now this is going to go faster, buy another one, and so on and so forth on down the line. The more assets you build, if you dump all that in, now maybe you need some of it, and you got some fancy habits, so you can take some of this straight over to your expenses too. It's however you want to do it. It's every situation is different, but this is probably how most of America does it. But with the infinite banking concept, if you just change one thing, then everything is different. So when you get your money in the bank here at a 0.5% interest, once you get this all the way built up, 0.5% interest isn't much. But if you've got $1 million, yeah, I'll take that. Okay. The more money you have in here, the more money you're now making with that 0.5% interest. Wouldn't it be cool if we could get something that would, pay, if it was guaranteed to pay 2 or 3% interest? We're already way better than what the banks are doing. But if it wasn't guaranteed, but has paid, a lot more than that, they paid out dividends on top of that. So, like ever since over 100 years, basically since the Civil War. So there's another way to do this. So instead of having all this in the savings account, what I would do is keep doing what you're doing, build up to a certain point, and then you take that, and instead of putting it on your purchase, we put it over here into the family bank. Okay? The family bank, then, this becomes your cash value. So your cash value is, right now, my cash value in my family bank policy is earning 6.6% interest. Okay? So this is the cash value, and every time you would do this, you just dump that into this policy rather than going here. Now, what you can do is you can borrow from your family bank, you borrow from this cash value, and you make your purchase. You're not taking this money out. When you make a purchase here, this money goes down to zero, and you're making 0.5% on zero, right? Here, I'm currently making 6.6%. This fluctuates a little bit, but it's guaranteed. It can never go, I think it's like 3%, that my policy can never go below. So it's not great, but it's better than that all day, right? So if I want to make a purchase, a liability, or say a rental property, once I used to do it this way. Once I figured this out, it's like, whoa, this is way better. So now I've got my chunk of cash value in my family bank, and this is, the insurance company is connected to that, okay? And so what this does, when I want to buy something, I don't take this out. This doesn't come out and come over here. The money comes from the insurance company, okay? The insurance company says, okay, you've got cash value, whatever the number is, and we know that's in there, and that's good. So the insurance company will lend you some money, and if you don't pay us back, we're just going to take it from your cash value, from your death benefit, basically, okay? Because this is an insurance contract. So right now, and you're like, okay, well, I don't want to do this because it's another loan. Well, look here. I'm currently paying 5.68% on my loans. I'm making 6.6%, and I'm paying out 5.7. So right there, it covers the cost of it. But the way this is simple interest. So if you dive into that, and this is compound interest. You're compounding. You're going up with compound interest, and you're paying out simple interest. So even if there wasn't a spread between the two, you still end up net positive, okay? So this is super hard to figure out, and it took me forever, and I understand what you're going through here, but hear me out. So the insurance company pays for the asset, okay? Now, the asset, you have to pay the insurance company back if you want to keep doing this, all right? Just like we did here, we took the money out, we bought the asset, and then we put the money back in until we can buy another. So let's say that's our goal. So what we're going to do here now is instead of taking the money and putting it back into the savings account, what we're going to do is we're going to take this couple $100 of cash flow, whatever it is that this asset pays us, and we are going to bring that back in, and we're going to pay the insurance company, okay? Now, once the insurance company is made whole, they're cool. Now I can do this again, all right? Your cash value the entire time never left your account. That's always growing at 6.6%, all right? So let's say we get this paid back, and then we do have to pay premiums on this every year, but that's cool because whatever this was, right, back in our checking account, back when we were slave to the bank, we're still taking this, and we can take this and pay the insurance company back, and then we can also take a loan from the insurance company to pay your premium next year. Or you just keep it in your savings account, get that loaded back up as high as you can, and then the next year we put the premium back on into our family bank, in which then adds another chunk onto the cash value. So the cash value goes up, and you've also got interest now on top of all that. So now you've got a bigger chunk that's making 6.6% interest. Meanwhile, you're knocking this loan down 5.7% interest. So there's a little arbitrage in there, but that is the basic how this works of the infinite banking concept. So if you run numbers to this, by keeping all of this money in there, imagine if you kept all your money in the savings account and you could just go buy another asset and you're still earning money in here. That's exactly what you're doing over here, okay? It's just a little bit different way of looking at it, and it's almost like I heard the analogy of why do we have credit card benefit? You know, I could take and I could pay any of my expenses. I could write a check, usually right from your bank. Say I want to send money in from the water bill. So I go dial up on the bank and I send the water company the money for my bill. Or if you can put that on your credit card, might as well put it on your credit card, and then you can get the points off of that at the end of the month. It doesn't cost you anymore, right? So you just put everything onto your credit card. Now at the end of the month, you've got some points. If you just do it straight from your bank, you got no points. It's kind of the same thing. You're still paying all your expenses. You're still doing the exact same thing that you've always been doing. You're just moving it over, adding one more little step to it. So, all right, I know this is tough to kind of comprehend, but let me know if you have any questions, everybody, and I hope I can help.